The average Chinese citizen saves more than 40% of their income. In the United States, it is less than 10%. This is not because Chinese citizens are naturally more frugal, but because for decades, the only real choice in China has been to save. Spending freely has never been easy or safe. There are huge gaps in Chinese healthcare and social security. Many people cannot rely on the state for long-term support. On top of that, the one-child policy, which China held on to for 36 years, left generations dependent on just one child to support them in old age. Families often face the daunting task of caring for multiple elderly relatives with the resources of a single child. As a result, only 38% of Chinese GDP comes from its citizens buying goods and services. In the United States, the number is 70%. This creates a fundamental problem. China cannot rely on domestic consumption to drive growth the way Western countries do. Instead, the country becomes overly dependent on selling products to other nations or on constructing apartment buildings, roads, and bridges. But there comes a point when you have built too much, or when other countries decide they want less of your products. That is exactly the challenge China faces today. China demands growth. The government sets ambitious targets. Official documents and speeches declare that the country must grow at 5% per year. If domestic spending is insufficient, growth must be manufactured in other ways. Money must change hands. Someone has to make it happen. And for a political system that demands results, the easiest solution is construction. Over the past 25 years, China has at least tripled the length of its roads. Imagine all the roads in the United States laid with asphalt. Every bridge built in the US in the last 20 years, plus all housing units, plus an additional 50 million rail lines. That is the scale of infrastructure built in China. It is jaw-droppingly impressive, designed to modernize the country's economy at an unprecedented pace. Yet there is a limit to how much can be built. There are only so many people to live in these apartments, drive on these roads, or use these bridges. Many of these areas became what are now called ghost cities, vast, empty urban landscapes built with the expectation that people would eventually arrive. Sometimes, entire cities remain largely uninhabited, despite millions of completed housing units. The phenomenon is a stark illustration of the limits of growth through construction alone. This brings the incentive problem into sharp focus. The economic principle is simple. You get what you reward. When an apartment complex is built, money moves from one group to another for materials, labor, marketing, and consulting. All of this activity contributes to GDP, whether or not anyone actually lives there. Build enough, and local leaders can boast of impressive growth figures, even if the expansion does not create meaningful economic value. Leland Miller of China Beige Book explains that GDP can be inflated through repeated construction. Build a bridge, tear it down, rebuild it, and GDP rises. It is not real, productive growth. China Beige Book collects independent data to provide an alternative to government statistics, highlighting issues that official reports often obscure. China is running out of things to build. Millions of vacant housing units exist, and some of the largest construction firms have gone bankrupt. Selling goods to the rest of the world is also limited. Other countries have less appetite for Chinese products, and many have erected trade barriers. Germany does not want its car manufacturers to fail. The United States protects its steel mills. India imposes high tariffs on electronics and other goods. Growth through exports is no longer as easy as it once was. At the same time, infrastructure construction is reaching its limits. Roads are built, bridges are complete, cities are finished, but without people to fill them, the cycle cannot continue indefinitely. China needs domestic consumption to increase. Normal household spending in the United States contributes approximately 70% of GDP, in Europe 52%, in Japan 56%. In China, it is only 38%. This is the gap that defines China's economic challenge, getting citizens to spend more. Why do Chinese people save so much and spend so little? The answer lies in history and structure. China's history is one of scarcity and struggle. Over the past 400 years, there have been 12 major famines, the worst killing at least 30 million people only 60 years ago. Land scarcity, floods, and droughts make food and resources insecure. Saving is a natural response to uncertainty. The one-child policy compounds this behavior. Today, many parents rely on a single child to care for elderly relatives, a situation called the 4-to-1 model. Healthcare costs are high relative to income. While the state covers 72% of health expenses, the remaining out-of-pocket costs are significant, often catastrophic. In a country where median income is $7,000 per year, the cost of a hospitalization at $1,200 represents nearly 17% of income. Families save to protect against such financial shocks. Moreover, Chinese citizens have limited options to invest and grow wealth. Unlike Americans, who can invest tax-free in retirement accounts or purchase stocks in leading companies, most Chinese people cannot turn savings into reliable returns. Investment opportunities are scarce, and the best companies are state-owned, leaving ordinary citizens without a stake in growth. The Chinese economic model suppresses household wealth and limits private sector growth in favor of state-owned enterprises. Major construction, energy, defense, and financial companies are controlled by the government. The average person cannot participate in the wealth generated by these enterprises. In contrast, American citizens can invest in public companies, which creates a feedback loop of wealth generation, spending, and economic growth. This structural limitation explains why domestic consumption remains low. Without policy changes to shift assets to households, strengthen social safety nets, or increase purchasing power, citizens cannot be expected to spend at levels that sustain long-term growth. Global tensions around trade persist because China's population does not function as a strong consumer market for international goods. Even a modest increase in domestic consumption, from 38 to 48%, could bring China closer to balancing trade. But such reforms are politically unlikely under the current leadership. Until the structural issues are addressed, growth will continue to rely on construction and exports, rather than genuine domestic demand. China's challenge is a complex interplay of history, policy, and economics. Low consumption results from historical scarcity, structural incentives, and limited investment opportunities. Without meaningful reforms, China's economy will remain dependent on unsustainable growth strategies. To understand China's economy more deeply, follow China Beige Book. Their research provides independent insights, highlighting trends that government statistics do not always reveal.